Hey, everybody, how's it going? I got another episode of Money and Stuff here for you. Episode number 9. We're still chugging along. I'm your host, Sam Rodriguez. Co-host is with me, Conor Shepard. Conor, how's it going, man?
It's going great, Sam. It's good to see you. Good to hear your voice. I actually have my cousin in town visiting for the weekend. He actually works in private equity out in New York, big fancy lawman.
Nice.
Yeah, so it's been a busy weekend, giving him a taste of Texas, so to speak.
Yeah. Nice. Well, at least it hasn't been scalding hot. It's only been in the 90s.
Yeah, it's definitely was a good weekend for them to come down. I've been sure to remind them of that.
Well, good deal, man. Always good to see family. Always good to see family. Yeah, well, let's get into it. I know you and I were talking a little bit ahead of this about what we were talking about today. And I think today's topic is pretty good. Been getting a lot of questions from some of our newer clients about this, right? So one thing that when we're starting to work with somebody, for some reason lately, people keep asking, should I be contributing to a Roth IRA? Right. And that's definitely one of the things that we get into when working with clients. But for some reason right now, people are kind of beating us to the punch, right? I don't know if it's been in the news more lately. I don't know what's going on, but people are asking about Roth IRAs. So I wanted to talk a little in depth about Roth IRAs today.
Yeah, I mean, what better time? It seems like more and more people are talking about it and trying to figure out, what do I do with it? What is it? And is it right for me?
So I think there's 3 important things that we should cover, right? So like you said, what is it? What is a Roth IRA, especially in relation to a traditional IRA? Who can contribute to a Roth IRA? I think that's very important to know because not everybody can actually contribute to a Roth IRA. And then who actually should be utilizing a Roth IRA, when it makes sense, when it doesn't really make sense. So I think if we cover those 3 topics, that'll give everybody a pretty good base as to whether or not a Roth IRA is a good thing for them to look at or not.
All right.
So let's jump into just what is a Roth IRA. So I think most people have heard the term IRA before. Maybe not everybody knows that IRA simply stands for individual retirement account, right?
Oh, that's what it stands for. Oh,
super creative, super creative. And the Roth IRA was actually named after the man who introduced it.
Okay. I was going to make a joke about okay, and who's Roth?
Come on. It was the guy who introduced it, right? So
wow.
In the financial industry, maybe not the most creative with names. So a Roth IRA as compared to a traditional IRA, I think in order to explain the Roth IRA, we have to first explain what a traditional IRA is, right? And a traditional IRA and your traditional 401k work very similar from a tax perspective, right? What happens is any money that you put into your IRA or any money you put into your 401k is not considered income for the year, right? So if you make, I'm going to use $100,000 for easy math's sake. If you make $100,000 and you put $6,000 into your 401k or your traditional IRA, to the IRS, it looks like you only made $94,000. So you get a pretty good tax break, right? That $6,000 is not considered income, so you're not taxed on it in this current year. The thing you have to know about a traditional IRA or a traditional 401k is because that money's never been taxed before, when you pull that money out in your retirement and you start using it, right? Because that's what we're all saving for. We're all saving to one day be able to use this money that we're saving. So when you start pulling money out from your traditional 401k or traditional IRA, the money's never been taxed before. So 100% of everything you pull out of there is going to be taxable to you at whatever the current tax rates are.
Okay.
Right. So imagine that you've been putting in a certain amount every year, and that amount has been growing pretty well for you. You probably are going to have a pretty sizable nest egg. You're probably going to be able to pull out a pretty good amount, and the amount you pull out every year is going to be taxed. So here comes the Roth IRA. So the Roth IRA, from a tax perspective, just works in the complete opposite. The Roth IRA is your chance to have some tax-free income.
Mm.
In order for it to be tax-free in retirement, that means you get no tax break for putting money into a Roth IRA today.
Okay.
Right? So you take money that is taxable money that you are going to pay taxes on in this year, and you put that into the Roth IRA. Now that money grows, and everything you put in, plus all of the growth that it's had, when you begin to pull money out for retirement, that money is completely tax-free and is not seen as income in the eyes of the IRS.
Mm-hmm.
I'm hoping that that was a simple enough explanation.
Yeah, I think so. I mean, it sounds like the primary difference really is just in how it's taxed. And I think you put it very well. You know, it just works in the opposite direction rather than put away untaxed money and eventually knowing, okay, it's going to be taxed when I pull that out. It's getting the taxing knocked out at the very beginning and knowing, hey, when I pull this money out, it's going to be tax-free income. It's going to be tax-free spending.
Yeah. So I think a great question is, why would I want that?
Mm-hmm.
So you may be thinking to yourself, Sam, that's pretty obvious. Who doesn't want tax-free income?
I love paying taxes. I love taxes.
But when you get into retirement, taxes can be a pretty big expense.
Yeah.
Right. And in retirement, everybody's main worry is making their money last as long as possible.
Yeah.
Right. Making your money last as long as possible can be done using, several techniques. One, growing your money consistently. Two is spending less, right? Or keeping your expenses down. And that's key, right? Well, taxes is an expense. So if you can keep your tax rate down, you're essentially spending less money, more money stays in your accounts and grows that you can use later on.
Yeah.
Right. So it's a very good tool to use to keep your expenses down in retirement. So that way your money can last much, much longer.
Yeah. So you have the clear difference in how the different accounts are taxed. What, if any, what other differences are there between them? Is there a difference in how I can invest with a Roth versus a traditional IRA?
We get that a lot. And it was explained to me very well when I was starting off about how to think about different types of accounts. I can't remember who it was that said this to me, but they said, you have to think of the names of these different types of accounts like candy wrappers for chocolate, right? There's all these different brands of chocolate, but on the inside, it's chocolate, right?
Yeah.
But what the candy wrapper decides is how that chocolate is taxed. So I guess the key learning is it's no different.
Okay.
Right? How you invest in your IRA or how you invest in your traditional IRA versus your Roth IRA, you can hold the same types of investments. Right? There are not Roth IRA investments versus traditional IRA investments. There's just investments. Right.
Okay.
The name just decides how that money is taxed going in and coming out of the account. So there really is no difference in terms of how much they earn or how much they could earn. The difference is going to come from how you decide to invest the money inside of the account. So you have just as many choices within a Roth IRA as you have within a traditional IRA. So I think one of the key things that people need to know, though, is not everybody can contribute to a Roth IRA. There are income limits as to who's allowed to contribute to a Roth IRA. Now, what I will tell you is those income limits are fairly high. So let's say if you're single, how do I want to explain this? So if you're single, the limit, the income limit is $140,000 before you cannot put any money into a Roth IRA. Now, I say before you can't put any money into a Roth IRA is because there's a range from 120,000 to, I'm sorry, 125,000 to 140,000, right? And I should say these are the numbers for 2021. So if you're listening to this in 2022, these numbers are probably going to be different. But in 2021, if your modified adjusted gross income is below $125,000, you can put the full allowable contribution to a Roth IRA. Now, right now, the full allowable contribution is $6,000 for anybody age 49 and below, and $7,000 for anybody who's age 50 or above. So if you make under 125,000, if you're single, or if as a married couple, you make under 198,000 modified adjusted gross income, you can put the full amount into a Roth. Now, the top end for single earners and the top end for married filing jointly are 140 and 208,000. So what happens is in between, say that 125 and 140 is there's a ratio, right? The further you get past 125, but are still under 140, you cannot make the full $6,000 contribution, right? There's a ratio that has to be worked out to figure out how much you're allowed to put in. My point being, though, is to know if you are nearing those income limits, you really need to get your modified adjusted gross income worked out to figure out, are you allowed to contribute to a Roth IRA? But again, if you are a single earner and you make under 125, you're going to have no problem contributing to a Roth IRA. And if you're married filing jointly and you make under $198,000 a year, you'll have no problem contributing to a Roth IRA as long as your modified adjusted gross income is below those numbers.
Okay. And you keep bringing up that modified adjusted gross income. That is a mouthful, first off. Second off, when you say that, what exactly do you mean?
What is modified adjusted gross income?
Yes, thank you.
Yeah, that's a good question. So I guess start off with adjusted gross income. So, or AGI is what some people call it. So AGI, you'll see as a line item when you do your taxes. It is what your income is after all of your deductions and what you're actually taxed on. Your modified adjusted gross income is your adjusted gross income as a modified version. So,
fascinating stuff.
Yeah. So basically what it does is it adds back some of the deductions that you took, right?
Okay.
And a lot of these deductions are things that most people aren't going to have, but you might have them. You can Google the list of things to add back if you want, but it's things like the student loan interest that you deducted. If you're self-employed, it's half of the self-employment taxes that you paid. Maybe if you have rental properties, some rental property losses that you took. There's several things in there. I think there's about a dozen that you can go through and see if they apply to you. But it's your adjusted gross income modified by adding back in a few deductions that you might have taken. So I guess now that we know who can contribute, the question is who should contribute, right? So you may think, wow, tax-free income in retirement, that's where I'm going to funnel all of my money.
Yeah.
From here on out.
Kind of seems like an easy no-brainer decision between the two.
Why would I do a traditional IRA and get taxed later when I can do a Roth IRA and not get taxed later? And a lot of that has to do with where you're at right now, right? And in particular, what tax bracket you're in right now. Right? And this is where it gets a little tougher to say who exactly should. And this is where some deeper planning should be had. So, you know, if you have an advisor that you trust that doesn't just take care of your investments, but also talks about your entire situation, looks at what your taxable situation might be in retirement, this is the time to talk about which you should be contributing to. But one group in particular that I think should be thinking about a Roth IRA over a traditional IRA is someone who is in a lower tax bracket, right? Because if you're in, say, a 12% tax bracket, well, contributing to a traditional IRA really isn't saving you that much money.
Yeah.
Right. And if you do a fantastic job saving, yes, you're saving 12% taxes right now. But what if you've created this huge taxable nest egg when you retire? You may actually end up in a higher tax bracket in retirement than you were during your working years. So why not go ahead and take the smaller tax hit now so that we have absolutely no tax hit later, right?
Okay.
And even someone who's in the 22% tax bracket, right? 22%, you might start thinking about splitting it up between traditional and Roth. For our clients that get into retirement, the thing I see that works best is to have a balance between the two, some taxable money, some money that's tax-free. And here's why. Not all of your money has to be completely tax-free for you to end up in an extremely low tax bracket in retirement. Because if you've created a balance between the two, then you can still pull out a pretty decent income by pulling from both your traditional and your Roth. And because it's only the traditional money that's considered income in the eyes of the IRS, you may still be in an extremely low tax bracket in retirement, right? So maybe you were in the 22 or the 32 or 24% tax bracket while you were working. Great, take some of that as a deduction now, because if you balance these two out, you can really put yourself in a much lower tax bracket in retirement. So maybe it makes sense to take some money as a tax deduction today while you're in a much higher tax bracket than you're probably going to be in retirement. So my point to that is the higher your tax bracket that you're in, the more sense it makes to take some tax deduction today. But what I will say is that it makes sense for everyone to have some tax-free income in retirement.
Yeah.
So I would still find some way to be able to put money into a Roth IRA or something that is going to come out tax-free. Now, that being said, you may say, what if I make too much money to put into a Roth IRA, right? Or maybe I'm getting close to retirement and all of my money is already in a traditional IRA or traditional 401k. I think that's a topic for another episode because there are definitely ways that if you are above those income limits, that you can still participate in a Roth IRA. Right. And if you are nearing retirement and you feel like you don't have a lot of time left to put money away, you still need the tax deductions. Maybe you don't have anything in a Roth IRA yet, or you feel like you don't have a good balance between the two. There are ways you can do it. Even if you're already in retirement, there are ways you can do it. But that is a much longer and much more in-depth, I think, topic that we need to go into. So let's do that next. Next episode, let's talk about, hey, I make too much money. I'm too close to retirement. I'm already in retirement. How do I create some tax-free income for myself if I didn't do it in my younger years? But for those of you who are listening, you're in your 20s, your 30s, maybe even into your 40s, and you're wondering what you should be doing, the more money that you can put away in a Roth IRA, so that way it's tax-free in retirement, obviously the better, the lower we can make your tax rate in retirement. But it's about striking a balance between the two. I highly encourage you to work with your advisor to figure out what that balance should be.
Yeah. So it sounds like the key for the majority of people is finding that balance. It's rare to have a situation where one or the other fits your situation completely, and that's the only area to put your money into. It should be sort of a hybrid of the two in terms of where you're putting it and what you're taking out.
Yeah, there's a lot that goes into the decision, right? Now, obviously, part of that is what things are going to look like in your retirement years. but a lot of it is also what your current taxable situation is. And so that's a year-to-year decision, right? So there's no hard and fast rule. Hey, you should definitely do a Roth IRA because you are whatever. It's a decision that you should sit down with your advisor every year and figure out, does a Roth IRA make sense for me this year? Right? You need to look at your entire situation and really figure out, does it still make sense for you? Or if it didn't make sense before, does it make sense to do now? I think that's it. I think that's it, right? What is it? It's a tax-free source of retirement income, but you get no tax benefit by putting money in it today. Who can contribute to it? If your modified adjusted gross income is below 125, you can contribute a full $6,000 if you're under age 50, or $7,000 if you're 50 or above. If you make 140,000, or your modified adjusted gross income is 140,000 or below, or between that 125 and 140, there's some adjustments we got to make. And then for married filing jointly, those numbers are between 198 and 208. Who should contribute? Again, if you're in a lower tax bracket, the lower your tax bracket is today, the higher likelihood it is that it makes sense for you to contribute to a Roth IRA. But again, for all of you, whether you contribute to a Roth or find a way to put some money in a Roth IRA, really depends on your individual situation, what things are going to look like in retirement, what your taxable situation looks like today. And I'd highly recommend you sit down with your advisor and figure out if it makes sense. Maybe the shortest, is that the shortest we've ever covered a subject before?
Hey man, we're getting efficient. We even got next episode picked out. Look at us.
Look at us
on top of it.
Getting better and better and better. All right, guys. Thanks so much for tuning in with us. Do we say tuning in? It's not like it's radio.
Thanks for hitting play on the podcast.
Thanks for finding us wherever you found us. Really appreciate it. Hey, for those of you who are listening to us on a regular basis, we really appreciate you. If you have any questions, please feel free to send them to srodriguez@foundationwealthpartners.com. We'd welcome any topic you have related to money or stuff, I guess. Money or stuff.
Hey, send us ideas. Let's talk about anything.
Send it in. Thanks, guys. We'll talk to you next time.
Securities offered through LPL Financial, member FINRA/SIPC. Investment advice offered through Foundation Wealth Partners, a DBA of Advisor Resource Council, a registered investment advisor. Foundation Wealth Partners and Advisor Resource Council are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Qualified withdrawals of earnings from a Roth IRA account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being opened for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply.